Hello, my overemployed friends. This is Ewan Morkel, EA, founder of Morkel Financial. I'm a tax professional, and here's a quick little tutorial on how to use my overemployed tax estimator. Just a quick disclaimer that these estimations are not entirely accurate. The calculator cannot account for self-employment income in its current state. So any 1099 corp to corp rolls that you may have shouldn't go on here, and you should probably consult a tax professional like myself to get an accurate understanding of what your tax liability will be. I'll just go through step by step what to put in each one of these inputs in the inputs tab. So under this column, this is just going to be your 2023 gross earnings by job. So if your total comp at J1, let's say, is $100,000, but you start it at the beginning of July, then you're only going to put $50,000 in here. Okay? And let's say you get paid semi-monthly at J1, so you're only going to put 12 pay periods, since you're only going to be working half of the year. Otherwise, it would be 24 the next year, assuming you kept that job for the entire year. Unless you've adjusted your withholdings during the year, you want to put your federal income tax withholding in this from your most recent pay stub in this box, which should match all of your previous pay stubs. So if you have changed your withholding throughout the year, you'll want to find your average withholding per pay period and put it in this box. So let's say you're withholding $100 per pay period. And so the way you see this is it's just under federal income tax withholding on your pay stub. So really straightforward. Then you also want to put in your filing status. So 1 is for single, 2 is for married filing jointly, and 3 is for head of household. You can look up online pretty easily what filing status you qualify as. And you should be able to tell just from your last year's tax return, as long as your marital status hasn't changed. Okay, and then let's say for J2, they're making $200,000 a year. Okay, and let's say they work the full year there and they get paid twice a month. Okay, and yeah, it's important to make the distinction between bi-weekly and semi-monthly. So if it's bi-weekly, you get paid 26 times a year. If it's semi-monthly, it's 24. And then let's say they're withholding $500 per pay period in federal income tax. And then they don't have a spouse, but if you did have a spouse, you would put their spousal earnings here. Sorry guys, this calculator does not work if both you and your spouse are overemployed. But props to you if that's the case. Way to hustle. And then, yeah, here's where you'll just put your 401k contribution. So that's why it says gross earnings up here, is because we'll take out your pre-tax payroll deductions here. So 401k, HSA, other. And then it's on an annual basis. So say you're contributing $20,000 per year. Okay, and then here's where you can put other income. So other ordinary income would be stuff like interest, and then non-qualified dividends as well. And then adjustment to income, that can be business losses, as well as any capital losses up to $3,000, because that's the maximum amount you can claim every year. And then if you liquidate a 401k or an IRA and just take a normal distribution from it, a normal non-qualified distribution, you're likely to have some withholdings there, and then there will also be a 10% penalty. So that will be calculated if you put it in this cell. Okay, so now let's take a look at what this scenario plays out as. So let's see if they're withholding enough to meet their tax liability for the year. This first cell, that's going to be the total earned income, or total income overall. So aside from long-term capital gains, because those will be taxed at a different rate. So that's going to be $250,000 there. And then $20,000 in 401k contributions are being excluded from income. Keep in mind that if you do put your net earnings, net of pre-tax payroll deductions, in box 1, in this box here, you're going to you want to make sure you don't double count those down here. So put gross earnings here, then take care of pre-tax payroll deductions here. And then on top of that, $20,000 exclusion for contributing to their 401k. This client also gets an almost $14,000 standard deduction, and that's just based on their filing status. Okay, so their total taxable income is going to be the net of these deductions, net of their income after these deductions. So it's only going to come out to $216,000 roughly. And then that gets plugged into the tax brackets for single. And then they're also going to have an additional $450 tax here. And this is going to be 0.9% of their wages above $200,000. So this is just an additional Medicare tax that is typically paid when a tax return is filed. So their total tax liability comes out to $48,450, and that's just these two added up. Federal income tax withholdings, we multiply this with this and we add it to this times this, and we get $13,200 withheld, which is not quite enough, as you can see. And then there's also Social Security tax being withheld, and that's what I love about this calculator over the IRS's calculator. Is that the IRS's calculator doesn't always account for the Social Security tax credit you get if Social Security tax is over withheld. So Social Security tax is withheld until you reach $160,000 in wages. Then your employer stops withholding it because you're only supposed to owe that much. But if, let's say, you have another job, so you reach the Social Security wage base at J2 because you're making over $160,000, but J1 doesn't know you've already made $160,000, so they also withhold 6.2% of all of your wages on this $50,000. So you're going to get that back in the form of this $3,100 here. So you're going to subtract that from your $48,000, and you're going to come up with $32,150 due in April of 2024. This, you just want to put the number of pay periods remaining in the year. So if it's the beginning of July, there's going to be 12 semi-monthly pay periods left. And that's going to be how much you are going to have to increase withholdings by every pay period. So they got behind on their taxes a little bit, but as long as they withhold this amount every pay period, then there is nothing to worry about, and they'll meet their tax liability for the year. And then they'll probably want to make some adjustments come January 1st. They might want to adjust down if their income stays the same, just because you don't want to withhold this much for the entire year. It's just because they started halfway through the year, if that makes sense. And then I'd like to let you know that if you withhold at least 110% of your prior year tax liability, you're not going to owe any penalties on a balance due the following year, as long as you get it paid by April 15th. So let's say your tax liability last year was only $10,000 because you've withheld $13,200 here. You're not going to owe any penalty. You're not going to accrue any penalties on this $32,000. So that's just something to keep in mind for when you are raising your withholdings. Is you don't have to raise your withholdings if you think you can come up with this amount, and you have a lower tax liability last year than what you're withholding. So if you have any questions regarding this, feel free to reach out. Visit morkelfinancial.com. I'll link it in the description, and then I'll also have a link to this tax calculator so you can try it out. I do everything from tax consulting. I can do estimates for you if you are self-employed and you need help, or I also just prepare tax returns. So if you need a good tax professional, I'm your guy, especially if you're overemployed and you value your anonymity. So like and subscribe.